All right, so let's begin. Multi-asset allocation funds are hybrid funds that must invest a minimum of 10% in at least 3 asset classes. Now, these funds typically have a combination of equity, debt, and one more asset class like gold, real estate, etc. Now, the advantages here that one sees are lesser risk than most of the hybrid funds as the investments are spread across multiple asset classes. Low allocation to stocks means the returns can fall behind in the rising market, suitable for an investor's horizon of that at least 3 years. Also, it's right now the only category that enjoys the benefit of indexation. But is this enough a reason for you to place these funds in your portfolio? Let's discuss more on this. I have with me Dhirendra Kumar, CEO Value Research. Hello, good evening, sir, and welcome to the Money Show. Thank you so much for taking time out. So, a lot has been already discussed about multi-asset allocation funds, but then this is quite a hot topic right now, since most of these AMCs are also coming up with this category funds. Now, if you just get into the nitty-gritties or maybe the basics of this category, multi-asset type of funds have existed earlier also in some or the other way. Talking about their performance, a little more than 10% can be said that's been delivered by these funds, which is almost okayish. The question and concern over here is the benefit of indexation with which the AMCs are also trying to tap in investors. Is this a reason enough for investors to look into these kind of funds? Also, you know, in terms of diversification, where we look at diversification from portfolio point of view, and this is a diversification that a fund is trying to give you. Do you think for better return one can really approach this kind of fund in their portfolio with the tax benefit?
Yeah, it's interesting that, this is the only category left where you derive the benefit of indexation. And if these funds actually, increase their allocation above 65% in equity, it will be treated as equity, which is not too bad because, you have to pay 10% of your gains. But yes, indexation getting, available only for this category is interesting, but that is not the only reason. The real reason why investors are pouring money and more and more companies who don't have one such fund is launching one simply because investors chase performance. 2022 was a good year because, that was the year when equity did surprisingly well. And that was coupled with, gold also doing well. And if 2 of the 3 asset classes do well, and debt was not all that bad because if you look at the debt allocation of these funds, it turned out to be 6-7% yielding investment, and weighted average of that translated into very meaningful about 16-18% return last year, and that is what investors are chasing. Investors' favorite pastime is chasing recent past performance, and this is carrying on. So far, even this year. It's up 14%. So
if an investor is chasing past returns, don't you think any other category, maybe in the hybrid category, any other type of fund would have been a better one?
Yes, but investors can't really understand what is about the when we talk of risk tolerance and relatively more stable asset category, it's not that, investors will be just as happy or unhappy with on a day like this when the mid caps are down 3%. These funds will actually withstand these kind of turbulence much better. But on all other days, when you look at the equity returns, they are, eye-popping returns, everything getting close to double digit, getting closer to 20%. That is something when investors will be disappointed because investors want, naive investors want the best of both. They don't want the fall and they want to ride the gains, the upside. And it's a very difficult thing. And here they're able to combine it in some manner. Whatever be the case, whether it be the selling point turns out to be indexation on a 3-year holding period. And during this period, I don't think investors will get disappointed because you end up catching the good part of the cycle. Markets are cyclical. All asset categories are also cyclical. So these funds are able to catch if a fund is able to make sure that it is allocated and keeps its allocation firm.
So that is a very important point to discuss, because when we talk about proper diversification across asset classes, it's also a portfolio approach that one must opt for. After having a well diversified portfolio, you also have a fund that's providing you diversification depending on the fund manager's capability. Now, what kind of approach do you restrict yourself to? Because you also have to understand at the portfolio level diversification and the fund level diversification in order not to get over diversified in any of the scenarios, in any of the asset classes. So how can one understand that?
No, my sense is that, the long-term performance of gold may not be very impressive, but so far I have been proved wrong. Also, the fixed income will have its own cyclicality, and it has been very much visible. And most fixed income fund managers also have not been able to anticipate anticipate it well, the rate outlook. When it comes to equity, it is cyclical, and right now we are going through a very dream run. Besides the hiccup, my understanding is, and my advice to investors will be, have your own allocation. Don't worry about these funds. Have your long-term allocation to equity. Have your immediate term consumption needs into fixed income. Have a little bit of, sovereign gold bonds if you have some appetite for gold, just because, you habitually we need to have gold for that reason. And if you look at your whole overall portfolio, there are different ways of looking at allocation. My understanding, I keep insisting that, broadly there are two asset classes you have to worry about: fixed income and equity. Equity gets you growth, fixed income gives you a stability and some return. And if you keep rebalancing it and have a simple rule for allocation, 20%, 25% into equity, 75% into debt, half into equity, half into debt, or, the other extreme, 75% into equity, 25% into debt, you will never be scared and driven out of the market, because it is very difficult to formulate a precise percentage which will make you comfortable. You just need to make sure that you're okay with the madness of the market on unusual occasions, and investors have to manage this allocation themselves.
So, Dhirendra sir, how will you explain the similar role of a fund manager for a multi-asset allocation fund? When you talk about equity exposure, debt exposure, although it's very restricted, but then how do they play? Talking about equity, what kind of market capitalization can they invest into, or do they do normally? What the kind of funds are available in the market right now?
Oh, it's a very wide variety. All different funds have their own approach. Some are, large and mid cap tilted. Mostly, it's anchored around large and mid cap, but there are funds which have a very significant allocation to small caps as well. And that is where we see that they are the outliers. They are the ones which are actually, the most rewarding in recent times.
How can a fund manager actually mitigate your risk and also, just get you away from the entire fear of volatility through a from a multi-asset allocation strategy?
No, these funds are, these funds have a utility. These funds have a utility for anybody who is going to start in mutual fund for the first time. It is a steadier take on growth. And once you invest in such a fund, these funds will not.
I think there is some audio issue happening. Yeah. Dhirendra sir, can you hear me?
Yeah.
Yeah.
Yes, I can hear you.
Please continue. Yeah, please continue.
Yeah, these funds are meant for the naive new investors in mutual fund who are looking at long-term investment vehicle, but a relatively steadier one. Because when investors chase performance, till yesterday they would have liked the small cap, but today they will dislike it simply because it has gone down so freely. So these funds help you get used to mutual fund and get used to acclimatize yourself with the equity behavior very, very nicely. So these funds are just meant for those investors. As you mature, as you get older with your investments, you have built your portfolio, you have a couple of equity fund, couple of fixed income fund, you start arriving at what is right for you, what you're comfortable with, then you have to really take charge of your allocation. And it can change quite dramatically depending on your needs. But these funds are useful for anybody who in his first couple of years of beginning his investments. These are very useful vehicle for somebody to fall in habit of investments.
Any particular type of category under hybrid that you might want to compare this fund with?
I would say that, aggressive hybrid is one such category because, these funds, we are just looking at the bright side of it. There could be a situation because gold is not a secular, is not a allocation which will rise. We haven't seen a phase. There has been phases when gold has given you a very equity kind of decline. And that is when these funds can also disappoint you. They can just nullify all the equity gains in a year or all the fixed income gains in a year. Wait for that. I would say that investor has to get used to the aggressive hybrid category or the conservative hybrid category because they are the meaningful allocation. They are very well defined. They rebalance themselves, and there the investors have the great advantage that you don't incur the cost or the tax of rebalancing. If I carry a portfolio of 75% equity and 25% debt, and if I rebalance it every year, my gains will get reduced by 10% to the extent I'm able to realize the gain. When you invest in an aggressive hybrid fund, you don't have to worry about it. You are not liable to pay any taxes till you realize your investments. So it could well be a long-term investment, and if you carefully choose one, it could be many, many years. Likewise, so mutual fund is a very effective vehicle for tax deferral. You are not liable to pay taxes even though the fund manager is acting every day.
One last question on the multi-asset allocation fund that I want to ask you, because a few funds also have their exposure in real estate via REITs or InvITs. Now, this particular investment category in real estate is yet to pick up in India. How do you look at it, and do you think it's advisable to maybe have a separate allocation of REITs or InvITs? Maybe if you're looking at real estate exposure in your portfolio, that makes sense other than having this exposure through a multi-asset allocation fund.
The mandate of these funds permit them to invest in them. Many other funds have also enabled in their offer document or revised their prospectus to invest there. But REIT and InvIT market has not evolved and has not gained maturity. Till recently, it was not even attractive to invest in them. Today, if they are investing there, it is just to just because their mandate says so, and they have they have tested the water. But I don't think one should look at it very, very seriously as an asset class because it has not emerged or not mature. But the way I look at InvITs and REITs is that it's an income yielding portfolio with a possibility of some gains over time.
That will be all. Lots to discuss, but then the time is actually up. Thank you so much, Dhirendra sir, for taking time out and explaining this category to our viewers today.
Thank you.
On that note, let's take a quick break, but then post that, let's talk about passive investment, and in that also this focus is on index fund. With me will be Suresh Satagopal to talk more on this after this break.